Same 500 stocks, same market exposure, similar benchmark exposure. This one can save thousands more in federal taxes every year than this one. The only difference is how they own them. I'm going to show you why, and I'm going to show you the version that can save you more. Here's what nobody is telling executives with concentrated stock positions. The most expensive decision you can make is not selling too early, it's owning the rest of your portfolio the wrong way while you wait. Two executives, same $5 million taxable account, same S&P 500 exposure, same returns. One owns a single ETF, the other owns the same 500 stocks directly in a separately managed account in their own name. By the year end, the second executive has generated thousands in federal tax savings from structure alone. And there's a version of this that can generate more. I'm going to show you both. And at the end, I'm going to show you the one decision that determines whether either strategy works in your favor or against you. It has nothing to do with which stocks you own. I'm Klemm, founder of Inflection Wealth Management. We work with senior executives and high-earning families navigating complex financial decisions around equity compensation, concentrated stock, and tax planning. This video is about two strategies, direct indexing and tax-aware long-short, that most executives have heard of, but very few actually understand well enough to know whether they should be using them. By the end, you'll have a clear picture of how both work, what they actually cost and save, and importantly, when they're the wrong tool entirely. If this channel is new to you, hit subscribe. We put out content specifically for executives navigating these kinds of decisions. Let's start with the problem direct indexing solves. When you own an S&P 500 ETF, something like VU, you own one share of a fund that holds the underlying 500 stocks inside it. The fund holds those stocks at the fund level. You don't own the individual companies directly. Here's why that matters for taxes. Say one of those 500 stocks is down 30% in a given year. That's a loss sitting inside the fund, but you can't harvest it. You only see the fund's net price. The loss belongs to the fund, not you. Direct indexing changes the ownership structure. Instead of one share of a fund, you own the 500 underlying stocks directly in a separately managed account or SMA in your own name. Same benchmark, same market exposure, but every individual stock is now in a separate line item on your statement. When one of those stocks drops, say it's down 30%, your manager sells it, takes the loss, and immediately reinvests it in a similar stock to keep the portfolio tracking the index. That loss is now yours to use. The rule they're working around is called the wash sale rule. You can't sell a security at a loss and buy the same security back within 30 days. The IRS disallows the loss. So the manager substitutes a similar stock. If they sell one technology company, they buy a comparable one. Factor exposure is maintained. Loss harvested. One important detail here. The wash sale rule applies across your entire household. Your spouse's IRA, your 401k, anyone buying the same security within 30 days of your loss sale can disallow the harvest. Your advisor needs to know the full picture. So what does this actually produce? On a $5 million portfolio, long-only direct indexing can generate between 1% and 2% of the portfolio in harvested losses in the early years. That's $50,000 to $100,000 in harvested losses annually, which translates to $12,000 to $24,000 in federal tax savings at the long-term capital gains rate of 23.8%, which is 20% long-term capital gains rate plus the 3.8% net investment income tax that applies at this income level. There's also a $3,000 per year offset against ordinary income, wages, bonus, salary. But that's not where the value lives. The real number is the capital gains offset. The $3,000 ordinary income piece is a footnote. The strategy can maintain similar benchmark exposure, but results may differ due to implementation and tax constraints. The fees run about 25 to 40 basis points compared to essentially nothing for an ETF. On $5 million, that's roughly $12,500 to $20,000 per year. Net of fees, the after-tax benefit in year one can be real, and it can compound. Here's something the direct indexing pitch usually glosses over. Long-only direct indexing has a structural problem in a rising market. Year one, you might harvest 1.5% of the portfolio in losses. By year 5, you're closer to 0.5%. The strategy quietly runs out of fuel. The reason? Losses can only come from stocks that are down from your purchase price. In a strong market, fewer and fewer of your S&P 500 positions are sitting on losses. The harvest decays, you're still paying the fees, and the math gets thinner. Tax-aware long-short strategies solve this by adding short positions to the portfolio. Here's the mechanic. The strategy holds a long book, say 130% of the portfolio in long positions, and a short book, 30% in short positions. So total market exposure stays roughly equal to the index, but the short book creates a second engine for harvesting losses. When a long position is up, its paired short is down. When the short is down, you harvest that loss. This can create additional harvesting opportunities and more market conditions. The harvest doesn't decay the same way. You'll hear these strategies called different things: 130 long, 30 short, 250 long, 150 short, long-short tax management. The specific structure varies by manager mandate. The underlying logic is the same. On the same $5 million portfolio, a tax-aware long-short strategy typically generates 3 to 6% of the portfolio and harvested losses annually. That's $150,000 to $300,000, 3 to 4 times what the long only generates. And here's the part that makes the short book particularly valuable at this income level. The losses from the short side are short-term losses. Short-term losses offset short-term gains, and the federal tax rate on short-term gains at this income level is 38.8% in 2026. That's 35% marginal rate plus the 3.8% net investment income tax. Compare that to 23.8% on long-term gains. So the blended federal tax saved on $225,000 of harvested losses, assuming roughly 70% from the shorts and 30% long-term from the longs, works out to about $77,000. That's the escalation I mentioned in the opening. Fees jump too, 100 to 150 basis points. On $5 million, that's $50,000 to $75,000 per year. Net of fees, the year one after-tax benefit is still meaningful. And for the right use case, the net math gets significantly better. Let me show you what this actually looks like in practice. I work with a household, I'll call them the Hendersons. Dual income, live in Michigan. One spouse is a senior executive at a publicly traded company, and the other spouse runs a professional services practice. Combined household income around $750,000, married filing jointly. They have $5 million in their taxable account, a mix of broad market index funds and employer stock accumulated from RSU vests over the years. Inside that $5 million is a $1 million stock position in the executive's employer stock. Cost basis on that position, about $300,000. Unrealized long-term gain, $700,000. Their goal is to diversify that position over 5 years. They know they need to. The question is what the tax picture looks like and whether there's a smarter way to structure it. Without any strategy, here's what they're sitting on. $700,000 of unrealized long-term gains at the federal long-term capital gains rate of 23.8%. That's 20% plus the 3.8% net investment income tax. The federal tax on that gain is liquidated in a single year is $166,600. Add Michigan's flat 4.25% state income tax, and you're over $196,000 total on that one position. Spread over 5 years, the annual federal hit on $140,000 of realized gains is about $33,300. That's manageable, but it's still real money going to the IRS every year just for the act of diversifying. Here's where the tax-aware long-short strategy changes the picture. In year one, their TALS account generates $225,000 of harvested losses, our midpoint estimate on $5 million. Those losses are available to offset capital gains dollar for dollar. So instead of paying $33,300 in federal tax on $140,000 of concentrated position gain that year, the first $140,000 of harvested losses absorbs it entirely. The federal tax on the year's sale could reduce to zero in this example. The remaining $85,000 of harvested losses carries forward to the following year, ready to absorb the next tranche of the unwind. Across a 5-year unwind, the cumulative loss harvesting from a TAL strategy can shield a meaningful portion of the $700,000 gain, potentially most of it, from federal capital gains tax and the years those gains are realized. That is a fundamentally different outcome from a standard ETF portfolio sitting next to the same concentrated position. Same market exposure, same investment returns, different structure, different tax bill. Now here's the part I promised at the beginning, the one decision that determines whether this strategy works in your favor or against you. It has nothing to do with which stocks you own. Every time you harvest a loss in a direct indexing or long-short account, you reduce the cost basis of the replacement security. Over time, the portfolio's overall basis drifts lower. The embedded gain grows. The strategy that was generating tax savings is quietly building a future tax liability at the same time. By year 5 or year 7, the long-only strategy is generating fewer harvestable losses, and the account is sitting on a low basis, gain-heavy portfolio that's expensive to liquidate. If the only plan is to sell it someday, the tax bill on that someday can wipe out years of accumulated benefit. There are 3 realistic exits, and one of them eliminates the deferred tax entirely. Exit 1, convert back to long-only direct indexing. Close out the short book and most of the complexity. You still own the long book with its accumulated embedded gain. It's a softer landing, not a true exit, but it simplifies the structure significantly and reduces fees while you figure out the long-term plan. Exit 2. Donate the most appreciated lots to a donor-advised fund. You get a full fair market value deduction, zero capital gains tax recognized on the contribution. For the Hendersons, who already give about $25,000 a year to charity, this is a clean fit. Instead of donating cash, they donate the highest gain lots from the direct indexing account. Same charitable intent, the deferred gain on those lots disappear. Exit 3. Hold for life and let heirs receive a step up in basis at death. Under current law, heirs inherit assets at their fair market value on the date of death. The embedded gain, however large, resets to zero. The deferred tax evaporates entirely. This makes the strategy especially powerful inside an estate plan for households who don't need to liquidate during their lifetime. Without one of those three exits, the deferred tax is still owed at sale. These strategies defer tax. They don't eliminate it. That is not a reason not to use them. Deferral has real economic value, especially when losses are being generated in your peak earning years at the highest rates. But it is a reason to know your exit before you start. I want to be direct about when these strategies make sense and when they don't. Direct indexing works well when you have a meaningful taxable account, generally at least $500,000, and the economics improve significantly above $1 million. When you're in a high marginal bracket where the tax savings are worth the fee and the premium. And when you have a use case for the losses, a concentrated position to unwind, capital gains coming from other sources, or a planned rebalancing event. Tax-aware long-short makes sense when the account size is larger, typically $3 million or above, when the concentrated position is significant, and when the household has the appetite for more complexity on their statement. A multi-page 1099-B at tax time, and a fee structure that runs meaningfully higher than an ETF. When it's not the right tool, a taxable account below threshold where the fees eat the benefit. No concentrated position or planned gain event to absorb the losses against. A household approaching retirement where income is dropping and the value of each harvested loss is falling. Or simply a situation where a low-cost index fund does the job better, which for a lot of people, it does. A low-cost index fund is still a very good answer for most people. This is a tool for a specific situation. Know your situation first. Here's the through line on all of this. The executive who owns a single ETF and the one who owns the same 500 stocks in a direct index account have the same market exposure. Same 500 companies, same returns. One of them is generating $12,000 to $24,000 in federal tax savings every year just from how the portfolio is structured. The long-short version generates 3 to 4 times that, and for an executive sitting on a $1 million concentrated position with $700,000 of embedded gain, the right combination of loss harvesting, a donor-advised fund, and a thoughtful exit plan can defer or eliminate most of that federal tax bill. What it requires is a plan for the exit. Every year you run one of these strategies without an exit plan, the deferred tax grows alongside the benefit. Know where you're going before you start. If you're holding a concentrated stock position, have a meaningful taxable account, and you've never modeled what the after-tax picture looks like with a direct indexing or long-short strategy layered on top, that conversation is available to you. Link in the description to schedule a call. No pitch, just your specific numbers. If this video was useful, subscribe. We cover this kind of material specifically for executives navigating equity compensation, concentrated stock, and tax planning. Thanks for watching. See you next time.